All right. Well, thank you everyone for attending this month's market update webinar for July 2025. We'll get started. I'm sure some people are still coming in, but we can start reading through some disclosures while we wait. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can read more about our disclosures on our website, and throughout the webinar, feel free to use the Q&A button at the bottom to ask any questions, and we'll address them at the end. Quick summary about who we are. Silverstone Financial, the firm, is a fee-only fiduciary independent wealth management firm providing various wealth management services, including financial planning, investment management, tax preparation, estate planning, and so on. You can learn more about us on our website. And Gordon and I here, we're both CFP professionals, have various designations, and both have master's degrees. I specialize in inheritance optimization, gift and estate planning, various strategies like that. And Gordon specializes more so on retirement planning and values-aligned investing. If any of that is interesting to any of the viewers, feel free to reach out to us. I'll start briefly talking about what happened the past month. I like to show this heat map is what it's called. And the larger the square, the larger the company, the greener, the more performance it's had the past month, so greater returns. The redder, the more losses it had. And the different companies are grouped into various sectors and industries so that you can see various trends, where you can see over here, the auto manufacturers had a hard time this past month, but also like insurance companies struggled, various credit, well, mostly Visa and MasterCard. You can see various patterns that go along with all of that. On the right side here is our various indices that we track. So the top 50 are the 50 largest companies on US exchanges by market cap, so how valuable the company is. So these mega cap companies, they returned about 6% for the month. S&P 500, so the 50 largest companies plus the next 450 largest companies on US exchanges returned about 5%. GARP, growth at a reasonable price, is an index that Standard & Poor's S&P also provides, is one of our preferred ways of investing. In the past few months this year, it's been underperforming the broader market, but you can see that GARP caught up a little bit this past month, returning better than the other most of the other indices at 6.4%. And small caps still lagging. They've struggled this year, up 4%. They have more exposure to tariffs and other uncertainty with the new administration, with other reasons as well, but they've continued to lag. Global ex-US, excuse me. So companies that are outside of the United States, those various stock markets, that they return 3.6%. They've performed quite well this year. Historically, for the past many decades, they've underperformed the US, with a lot of investors trying to diversify outside of the US with the new Trump administration's policies regarding various reshoring in terms of trying to incentivize companies to manufacture in the United States, and other kinds of effects on the US dollar. it has pushed a lot of investors to look abroad. So historically, ex-US companies have underperformed. This year, they've performed quite well. And this month, they're lagging a little bit. The US, as there's been more of a resurgence, turning around a little bit, investing more in the US as some of the tariff fears have at least gone on the back burner, haven't been talked about as much, but our expectations is they'll probably pop back up at some point. Aggregate bonds returned about 1.4% total return for the past month. Gold was mostly flat after a pretty good start to the year. Crude oil is always a very volatile asset class. It was up 7% for the month. And Bitcoin was up 3% for the month. So actually a pretty calm month for cryptocurrency, which is interesting. And I'll quickly fly through this is now the year-to-date chart. So the last one was looking at what happened the past month. This includes the last month performance, but also goes all the way back to January. So you can see that the S&P 500 had outperformed small caps significantly. These small cap stocks are still negative for the year. But especially when you compare the S&P 500 to ex-US companies, up 17% for the year versus 6%. That's an 11% outperformance. Very impressive, and still shows that even though this month the trend hasn't continued as strongly, ex-US has outperformed this year, and at least we're viewing that as a likely continuation, not to be fully, sell everything in the U.S. stock market, invest only abroad. That's not any kind of recommendation that we're making, but we wouldn't be surprised if foreign companies continue to at least be more attractive than they have been historically. Aggregate bonds up 4% for the year. Gold, as I had mentioned before, up 25% year to date. That's another fear about inflation, fear about the new Trump administration's various policies. Gold being seen as a place of safety. Crude oil quite volatile, down 9% for the year, and Bitcoin up 15% for the year. So again, these bottom ones are usually pretty volatile classes. Not always gold, but crude oil and Bitcoin can be quite volatile. So it's nice to look at, but it's hard to glean information for them specifically. This next chart I like to show each month. This chart shows the seasonality and cyclicality of the stock market. A lot of people don't know that there are actual trends month to month when you look at what the S&P 500 does, historically speaking. Now, these are averages over 100 years. Any month could have a positive or negative return, regardless of how history, has leaned one way or another. But it's very interesting. We've seen this year not really follow trends where the first, second, third, and fourth months of the year, the beginning of the year, are usually pretty good. We had strong underperformance. Of course, that has to do with the volatility with tariffs and other kind of uncertainty with the new administration. And then May and June are historically some weaker months, and we saw quite strong returns. And again, it's because of these uncommon events. You don't have Donald Trump becoming president and then implementing tariffs, then unimplementing most of the tariffs. That definitely causes some variation to the averages of the past 100 years. So yeah, the outside shows the averages, historical averages, and the inside shows the actual return so far this year. So about 6% for the year. And honestly, it's a pretty normal return pattern. A 12% return year, if this was annualized and the exact same thing happened the second year, that'd actually be a pretty strong year. Historically speaking, depending on the time period you sample from, stock market returns 8, 9, 10%. So a 12% year would be slightly above average, would be good. And then this is my last chart that I have here before Gordon can speak, which is the S&P 500 daily chart. I've kept the exact same annotations, drawings that I had for the past 2 months, honestly, because there's not that much more for me to say. but it's nice to be able to look back. And when I had originally drawn these, we had it right, we had cut out right here at May, so didn't have these 2 months of data. And you could see, short candles, that's how volatile it was in a specific day. Usually there's less fear, versus you can see some really big candles. These are the day performances happen when these tariffs come into effect. And you see how quickly it dipped down, which is why there were so many news headlines and honestly a lot of calls to financial advisors about, oh, am I okay? But now we've recovered. A lot of that has been, the tariffs have backed off. There's been a little bit more certainty. Could it be pricing pushing the pricing being pushed up based on tax cuts or other kinds of short-term promises? Is possible. It's honestly difficult to say if this is extremely sustainable or if there could be a pullback. All the uncertainty coming with, honestly, the administration leads to it be very difficult to have certainty or predictions or estimates regarding to what the stock market's going to do. So just want to show where we are, where we were, and how much the market has recovered. We're now back at all-time highs here. So pretty incredible times to watch the markets. Anything you want to add here, Gordon, or should I move on?
Well, yeah, I mean, just on the to follow on what you were saying about the difficulty to predict. Usually, when there's conflict in the Middle East, you see oil prices going up and people worried about supply shortages. But for some reason, we've seen oil prices not really that high. They're down since the beginning of the year. So yeah, things don't always behave the way you think they will, because sometimes the market has already baked in a prediction about something by the time it becomes news. Sometimes the news is truly a surprise, and sometimes it's not that surprising really to investors. So without an ability to read the minds of the major investors, it's always difficult.
Yeah.
So I wanted to just talk about briefly where we are with the housing market. I saw this top chart here last week and found it just really surprising. We've got the biggest gap between buyers, the biggest shortage of buyers, I should say, that we've ever had. Now, they haven't really been tracking this statistic for very long, only since 2013. It's not an arbitrary number that we just stopped the chart at 2013. It's just that's when they started measuring these things. So, but we see that it's putting some downward pressure on home prices. Probably we won't see the big gains that we've seen in recent years in terms of home prices because of the shortage of buyers, and interest rates are a big driver with that. I think if you had asked me 6 months, 9 months ago, I would have thought that interest rates would have come down a bit since then, but we're still 6 3/4 around where we've been really for quite a while. And so when we saw the good economic numbers at the end of last week, we saw some surprisingly strong unemployment numbers. The unemployment rate ticked down 0.1%. And so why would the Fed cut rates when the economy's doing pretty well on the employment side? So it's hard to see rates coming down in the immediate term, and so I expect this downward pressure on home prices to continue to build.
Yeah. All right, so we have quite a number of notable events this past month We have 3 slides of 6 events to talk about. So we'll try not to spend too much time on any one event. Of course, at least that's very hard for me. I'm quite a rambler. I like to embellish and keep on adding various trails of thoughts. But I'll try to fly through at least the ones that I'm going to be talking about. So the first one that I wanted to mention was Chime's IPO. It IPO'd on June 12th. What was interesting about Chime's IPO, other than its size, is a large fintech company trying to disrupt the banking space. It IPO'd at a price of $27 per share, but it jumped 37% on its first trading day, closing the day $10 higher at $37 per share. Now, since then, it's cooled down quite a bit, about 26% down from that day. So it settled around a $32 per share valuation. This is also still less than a month of trading data. So I'm not saying, well, we've hit a fair value. It's just interesting to see how much it spiked in the first day, and it's cooled off recently. Is right now it's sitting around $11.6 billion total valuation, which does make it quite a valuable company, and it makes it one of the larger IPOs in recent memory. And we'll see if there are more IPOs in the future. We've had, I would say, fewer recently. It's been less, at least big notable ones. We'll see if we get some more interesting ones come out in the near future. The next notable news article that I remember seeing is timely, since last month we had spoken about 23andMe, which had went bankrupt, and is that DNA testing kit. It went bankrupt, and out of bankruptcy court, Regeneron, which is a drug manufacturer research developer, had planned on buying it. And it seemed like it was pretty certain that Regeneron was going to win the bidding, or however, I actually don't know how that a specific bankruptcy process works, or what nuances there are involved with it. But the most recent articles have said that Anne Wojcicki, I'm not sure exactly how to pronounce her last name, she was the CEO, or maybe is still the CEO of 23andMe. I believe she helped found it. And so she herself will be buying back the bankrupt company for $305 million. I'm not sure if that's backed by other kinds of investors, or if she just has that money. It would be interesting if she was able to have that much money, yet the company go bankrupt. But that's not so, like, sometimes their CEOs are able to capitalize on their position better than the company itself can. Who knows? But as of right now, it might be that 23andMe is not fully dead and is not being purchased for its data. It might have some sort of resurgence, or who knows, maybe Anne's trying to flip it to some other company buyer. We don't know. But we'll follow it. And I just wanted to add that update, since last month or the month before that, we had mentioned that Regeneron was buying it. The third one that I want to mention, it doesn't affect probably anyone on this call, but we had mentioned it a previous webinar a few months ago. Bain Capital had bought the financial technology company Envestnet, and Envestnet makes lots of what I'll say is the financial plumbing, the software for a lot of the financial industry. A lot of financial advisors, such as ourselves, use various Envestnet services. We pay for their softwares and such. And they make Money Guide Pro, which is a financial planning software. They make various trading algorithm softwares. And Bain Capital had bought Envestnet, which is this big bundle of various company software packages. And Bain Capital is a private equity firm. And private equity firms, they have various ways of making money, but the expectation was, at least from outside commentators, was that Bain Capital was going to buy Envestnet and was going to break up the company into its pieces, thinking that its pieces were worth more than the sum of the sum of its parts were worth more than the whole, or whatever the expression is, where it had become too much of a beast with various company tie-ins that the private company, the private equity firm, Bain Capital, would be able to break it apart and sell each of the pieces to whatever the highest bidder is, because that highest bidder would be able to have more value from each of the pieces. Well, I had said that a few months ago, and we see the first that first action materializing, where Bain Capital is selling Investnet's Yodely, which actually does affect Gordon and I. Our client hub, where most of our clients interact with, is a financial planning software called Right Capital. And Right Capital, you can link all your accounts to it. You can link your bank account, your credit card, and your investment accounts, and your house, and all the various parts of your financial life. And you can see your net worth in one place. We can project out how your life is going to be, saving to retirement or after retirement, how you're going to spend it and such. And Right Capital uses Yodely in its own software to aggregate those accounts. So Yodely is an account aggregator, allows you to link various financial institutions together. And so we don't know if that's going to change pricing, if it's going to change how these various softwares work. What we can say with pretty good certainty is it's not going to change how cyber secure the systems are. We're confident that these M&A deals aren't going to change how seriously cybersecurity is taken in any of these arrangements. But it is just interesting to see the first pawn fall, and I'm expecting at least Investnet to continue to be broken up into these various pieces. So long story short, Bain Capital sold a part of Investnet to another private equity firm called STG, Symphony Technology Group. We'll see if there's any other noteworthy events in the future that we'll bring up to you if they come.
So we've got 3 more mergers to talk about. One kind of, I guess, to me, I would say kind of a bad merger, one good merger, and one kind of a weird situation we have. So Warner Brothers Discovery split into 2 companies. So you have these media companies are wanting to isolate the low revenue TV kind of old media into separate companies, probably because the incentives for the CEOs are such that they get paid more for growing stock and growing the companies, so they want to offload pieces of the company that's not growing. It doesn't really have a whole lot to do with shareholder value, in my opinion. Or I mean, I suppose maybe that they'll say that, well, then it allows buyers to get into the company and only buy the part that they really want. But when they came together in the first place, there were supposed to be synergies and all that. So we've seen these constant churn around media companies and billions of dollars over the years going to the investment banks, which don't really add any shareholder value. A merger that is more of a traditional way to add value. Home Depot is buying GMS Gypsum Supply. It's a company that's one of Home Depot's biggest suppliers. It's what we call vertical integration, where you have companies that are in different steps of the process of getting goods from raw materials to consumer goods getting together. It's interesting also because Home Depot kind of has a very similar business model to Costco, wherein they don't actually pay their suppliers until the customer buys the finished product in the Home Depot store. So all the stuff that you see in Home Depot, when you go there, is actually still owned by the supplier. So Home Depot has very low um, cost of carrying inventory already. But um, you know, they didn't want somebody else to get hold of GMS, one of their rivals, and then raise the prices on the things that they're buying from them, I suppose. So good merger for Home Depot. And then the third one here, U.S. Steel shares are up sharply with the takeover of U.S. Steel by Nippon, a Japanese steel company. But there's this golden share that was part of the deal where the Trump administration would not approve it without issuing this golden share, which basically gives the U.S. government the ability to veto certain actions that the company might want to take in the future. It's not clear exactly everything that they get. The president said that the share gives the president total control. That's a direct quote, but he provided no specifics on exactly what that was. One of the senators familiar with the deal said that it gives the government control of several board seats. So kind of interesting there, and it just shows it's part of a growing movement that we've seen of companies issuing different kinds of shares and controlling shares in a smaller number of hands as a way to kind of limit shareholder activism. So, for instance, with Berkshire Hathaway, they have their A shares, which have more voting power than the B shares. And you have Google. They have two different kinds of shares, one that are voting shares and one class that are not. So we'll see if this kind of golden share idea is just a crazy one-off, or if that type of thing gains momentum and is implemented elsewhere.
Yeah, I think I remember. I don't know if it's still the case. If any holdings have been sold, but I know Facebook, Mark Zuckerberg, he had specific shares that his shares had 20 votes to the common share. So even though he didn't hold the majority of shares, he did have the majority of votes. And I remember, I think it was 6 years ago, 5 years ago, I'm not sure when, but at some point when they were investing extremely heavily into the metaverse, and investors were worried that they were going to spend all their free cash flow. There's going to be no profits for the investors. It sold off very sharply. And one of the reasons why it sold more sharply than people would have thought is because the shareholders didn't actually have a voice to change anything. If Mark Zuckerberg felt it was what was best, then that was that. So sometimes when the control is consolidated, it can lead to better outcomes, and it can lead to worse outcomes. It really depends on the situation and who's making the decisions and how it all works out. What I definitely find interesting about this golden share thing is it is putting quite a bit of power over the U.S. government's getting quite a bit of power over private companies, where historically various mergers and acquisitions could be turned down essentially by the Justice Department out of fear of monopolies and that kind of stuff. But here it was less so about monopolies, I believe, but more so about losing a U.S. company to a foreign holder. So in this case, a U.S. Steel, very American, going to a Japanese holding company. And having this, well, you can only do it, but then the U.S. government has power over it and can have board seats and other things. Not saying it's a bad thing, because it does still provide. I would assume they would veto like U.S. plant closures and outsourcing the steel to China or to Japan or to other lower cost places. But it is just interesting to see more consolidation of power, which we see outside of econ, more so in the politics scene. So very cute.
Yeah, that's a great point, Jeremy. I mean, it's so ironic. This is the sort of thing, insisting on board seats for the government is the sort of thing that left or Labor Party governments have done in Germany or the UK, when the Labor side of the political spectrum had more power. So rather interesting turnabout.
Yeah, can be. It's sometimes ironic, so it's interesting.
Yep.
All right, so we got through 6, so we have 12 more. Talking about technology and crypto news, one of the, we'll say, long anticipated, more than 6 years, probably like 7 or 8 years, that is being promised, is Tesla robo-taxis are now on the streets, only in Austin, Texas, where they have a small limited radius where they can operate. But it's super interesting to see. Do you have anything to add about that, Gordon?
Well, yeah, I think it's in the long run. I mean, this is obviously the way things are going to go. We're seeing, labor being replaced by robots, and it's interesting that this is the first place that we see it really publicly, and in an area where safety is such a concern. It'll be very interesting to see. I feel like at some point, if the cars can all talk to each other, then it would be far safer than human drivers. So it'll be interesting to see, like, if the different systems eventually have some kind of way of communicating.
Yeah, like an internet, interwebs, as they would say, if all of it connected. Then again, there's the fear of, if they aren't independent and there'd be a hacker that wanted to cause mass casualties. That is a thought process, but definitely in terms of efficiency, it's like, okay, well, if you know the car in front of you is going to accelerate the 60 miles per hour, then you can accelerate at 60 miles per hour. The main reason there are a lot of ghost, I forget what they're, phantom traffic, or just traffic happens out of nowhere. It's just because you don't know what the person in front of you, next to you, and behind you is doing. So you have to act more cautiously. But yeah, we see robo taxis in Austin, Texas, and we see like Waymo has been having robo taxis in San Francisco, and I forget, maybe Phoenix, Arizona. I forget where the other places they operate in, but they've been doing it for years and have had very few issues. Mostly, a lot of experts attribute it to them being able to use LiDAR, which is a laser technology, versus Tesla robotaxis only use cameras. And there's some fear that, well, if the camera isn't able to see something correctly, like is being blinded by the sun, it could be more dangerous. We'll see long term what regulators allow and don't allow for further public use outside of these small test cities.
Yeah, Google owns Waymo.
Waymo, yeah.
So I feel like they're a little bit ahead, but see.
I would place them very far ahead, even though their market caps are not the same. Like Waymo, I think, is valued around, it's within Google, so it's not exactly, it's hard to strip it out specifically, but it's between like 100 and 200 billion is what they expect Waymo to be valued at, versus Tesla is much more than that. But it also, they produce cars, even though not that many, and they have other aspirations like robots and that kind of stuff. So we'll see how it all goes. So other technology news, Apple, so the producers of your iPhone, they've been behind on the AI race, well behind OpenAI, which is heavily integrated into Microsoft, and very behind Google's Gemini and their Google Assistant and such. So there has been a lot of rumors about them potentially buying Perplexity, which is another large AI company. It's private, and honestly, I don't know as much about it, but that would help them catch up a little bit. Nothing has been officially purchased, but it is interesting to see Apple potentially doing a deal, because Apple doesn't buy that many companies. From my understanding, usually they try to in-house most of it instead of buying. They only buy companies if they really feel like what that company is doing isn't able to be replicated by them, their own engineers. So we'll see what happens there. And then just a fun extra one, maybe not fun for the users, but Meta, which talking about Zuckerberg. So Meta was Facebook, rebranded to Meta, and now is more so the holding company of Facebook, Instagram, WhatsApp, and so on. And so for years, I would even say decades, I remember when they had bought WhatsApp and they weren't sure how they're going to make money off of it. And so WhatsApp was very much a play on market share. Let's just get everyone on their phones to have WhatsApp. And for us our US listeners, WhatsApp is still very common, but it's much less common in the US than, say, India or the Europe or just outside of the US. WhatsApp's everywhere. And so there was a long speculation on how Meta was going to find a way to make money off WhatsApp, because it's a free app that lets you message between them. And a decade later, and 1 billion users, or however many they have, which is, you know, a massive, massive amount, they've decided they're just going to do a classic model of, we're going to advertise on it. And I'm sure it'll make them lots of money. The fourth news event that I want to talk about was SpaceX shares. So SpaceX is Elon Musk's other company that shoots up rockets and such and wants to colonize Mars. They've become, it's a private company. You can't invest in it. But an investment startup in New York called Republic is offering users exposure to SpaceX by issuing tokenized representation of shares. And I had seen another article recently about how Robinhood is doing a similar thing with OpenAI, and I believe SpaceX as well. I think Robinhood's options are only for European markets, most likely for regulatory reasons. They might have been able to get it into Europe, but not in the US yet. But from what I understand, and this is very like frontier of finance that honestly, you know, is still evolving, and I'm still even trying to learn a lot about it, is how it works is like Robinhood, or this company Republic, goes out and starts what's called a special purpose vehicle, SPV, and it's a subsidiary company that then goes and buys these private shares. And I believe it's really hard to get your hands on them. So I believe they're purchasing it from employees of these companies. So employees of SpaceX, employees of OpenAI who want to sell their shares. And what's even more strange is usually these private companies, they have clauses that require shares, if they're going to be sold, to have right of first refusal sold back to the company. So I don't know if that OpenAI and SpaceX don't have that clause, which I'd be surprised about, or if they turn down the ability to buy back the shares, which I'm surprised about, or possibly the employees broke their contract without knowing, or intentionally broke the contract while knowing, to sell their shares to these special purpose acquisition vehicles. So I don't know. Again, it's very interesting, and it'll be interesting to see how it plays out. But once these shares were sold, whether or not legally or not, we're not sure, then Robinhood, Republic, whoever is running the special purpose acquisition company, then reissues shares for that special purpose acquisition company. So it's similar to, like, if you think of a REIT, a real estate investment trust. The company gets money, goes out, buys real estate, owns the real estate, and then sells its shares to the public, and then you own shares of the real estate company, and then indirectly own the rental properties. Here, you're doing the same thing, but you're getting access to a private company through these special purpose acquisition vehicles. But instead of issuing shares via like a public offering, initial public offering, they're selling tokens, crypto based blockchain tokens. I won't call them cryptocurrency because it's not technically cryptocurrency, even though it is. Blockchain is the same technology as cryptocurrency. They're blockchain tokens that represent shares. So at the very best, they're derivatives. That's a financial instrument that derives its value from another financial instrument. We don't know if they're worth. We don't know if they necessarily directly represent ownership, or if they represent pseudo ownership, or if the ownership is real because they were the sales of those shares are illegal or not. And there are a lot of questions, but it definitely revolutionizes a lot in this space. Specifically, it raises the question that's been asked a lot about should there be barriers to entry? And there's pros and cons on both sides for barriers to entry in investing. Is why shouldn't the normal person, John Smith, well, shouldn't he be able to invest in SpaceX? Well, the main reason why usually these private companies are not public is there are less disclosures and there's higher risks. So you need to be an accredited investor. So you have to be very wealthy, have some knowledge in investing to be able to have access to these private investments. Because there's higher risk, you need to be able to actually retain that risk versus not knowing that you have that risk and then ending up being hurt long term. So there's investor protections thoughts, but there's also an argument to be made of, well, even if I am accredited, or even if I do know what I'm doing or know the risk I'm taking on, I just don't have access. I don't golf with a private equity buddy that knows the guy who works at SpaceX that can get me an investment deal. So there's that argument of, well, democratizing these investments that historically only hedge funds or other kinds of large institutional premium investors could get access to. So I'd love to hear, Gordon, what your thoughts are on whether or not the pros and cons of getting access to these private companies, private investments to the masses are, and whether or not we should be doing it through blockchain tokens because it is more efficient than IPOs. You're going to cut out the investment bankers and that kind of stuff, but it is still new technology, a new horizon. We don't know.
Yeah, I think that the blockchain is an interesting and evolving technical application. But the other thing about why we don't have average investors getting into these private companies is that there's less standardized information about those companies, right? Private companies don't have a history of earnings to analyze. They don't have, their accounting statements may not be, may have some exceptions to generally accepted accounting principles that all public companies have to adhere to. So there's an informational hurdle to really doing due diligence. And when people invest in these private companies, a lot of times they're just kind of taking somebody else's word for it, right? You have some trusted, person at the brokerage house who, has access to certain shares, or, the brokerage has just certain funds that only their top investors can access, and there's a gatekeeper there, and yeah, it does help the rich stay richer, and there is a democratization argument to be made. Personally, I find it's hard to do due diligence when you don't have the training in, how to read all of these legal and accounting statements. So.
Oh yeah, I can attest to that. I've been For those that follow my journey, I've been getting my CFA designation, the Chartered Financial Analyst designation. I finished my level 2. There's a third one. So I usually consider a very difficult designation to get. And um, even people that have these Chartered Financial Analyst designations, like know how to read balance sheets and accounting statements and various, understanding of financial markets, it is very difficult to understand and do that due diligence on whether or not something is a good investment. But there's just, I kind of come back to like, well, if there's a way for, there are already ways for the average person to hurt themselves financially, where you could just easily open DraftKings and bet on sports, whatever. But like more so, if you think about, well, I want to buy leveraged call options on GameStop. Some of those worked out, a lot of them didn't. But like there's already these public ways that people that don't know, or at least do not have historic or traditional investing education, can take wild risks. Why not let them have access to what I would consider tamer investments? Less disclosure, less knowledge around it, but still tamer than like some crazy things that they can already do. So certainly interesting to think about and debate.
Yeah, just one last point I would say is that in the case of SpaceX in particular, that's a national security. They're involved in, an area of technology that's potentially, um, in the future, an extreme uh, area of competition with China when we think about, and Russia when we think about control of space. Um, Having the allocation of capital subject to the wild swings of the market um, when it's these extremely important companies, I worry about that.
Yeah.
But moving on to, um, we could talk all day about this, you and
Sure.
I. Yeah, so the SEC approved Grayscale's proposal around creating a new ETF that will contain multiple cryptocurrencies, Bitcoin, that's the BTC, and Ethereum, ETH, and others. Um, I think they're saying that it'll be like 80% Bitcoin, 79%, something like that, and another 12% in Ethereum, 5% in the next one, and then very small amounts of the others. But um, it's interesting idea, and what it's really showing us is the continued adaptation of crypto into mainstream acceptability um, as an investment. And maybe part of that is because it's profitable for these intermediaries. We see that IBIT, which is the Bitcoin ETF, that's a BlackRock fund. It's the third highest fee revenue generating ETF out there. It's a good sized fund at about I believe it's around 69, almost $70 billion in the fund. But not by any stretch one of the top largest funds, not even in the top 50 here, I would suppose. And so, but it's generating profit. There's very good margins there in that fund for BlackRock. And so yeah, we're going to continue to see more adaptation by Wall Street as long as it's profitable for Wall Street. So yeah, we're just observing the trend continuing.
Yeah, it's interesting to see. We've had multiple stories talking about crypto becoming more mainstream, more accepted in finance, and it's definitely innovative seeing like blockchain assets and such, or blockchain technology being used in as an alternative to traditional stock exchanges and such. So we'll see as it progresses. It's definitely interesting for us finance nerds over here. All right, last slide, talking about more macroeconomic news. I'm sure what most of you expected us to talk about when you opened up the the webinar. So I'll start out talking about. I had actually seen a news article I posted on my Facebook and my LinkedIn. If any of you want to follow, I'm sure you'll see some interesting news things that I post every so often. The judge found that there were various court cases against lots of finance companies for various reasons. Knowing finance companies, there are plenty of reasons to sue them sometimes. But a judge found in two separate cases, so two different judges, I believe, found in two separate cases that both Wells Fargo and LPL, which is a brokerage house, that a very large one that's usually in the background for a lot of companies. You might not even know that you're working with them. Do not have fiduciary obligations to act in the best interest of their clients when it comes to their cash. So a lot of these brokerage companies, Charles Schwab is very well known as a huge, definitely the majority of their revenue from being custodian comes from cash sweeps into their bank. So, you have a brokerage account, you have $10,000 in cash there, you haven't invested it yet, or, you've invested the majority of the account, but there's just some leftover few $1,000s that doesn't exactly fit into your portfolio. Well, they're happy to have you let the cash sit there. They sweep it over to their bank. The bank gets to invest it at 4% into high yield treasury bills, and they pay you 1/100%. And that's what's called a net interest margin spread there, where you can they can give you less money than they can generate on your spare cash. And so it's not surprising that brokerage companies, this is a profit center for them. They need to be profitable to be able to provide the services that they provide. So I'm not trying to say that they should make profits. But it's important to note that they don't have a fiduciary obligation. So the advisor that you are working with that is at Wells Fargo or is LPL, or honestly any company that you're working with that then has a custodian that holds your accounts, many of them would be the ones that have that fiduciary responsibility, not the brokerage companies. But when I had posted on LinkedIn and it actually kind of blew up, a lot of advisors were upset, is pointing out that a lot of times these advisors have conflicting interests or other kinds of issues that can prevent them from being a fiduciary 100% of the time. If you work with various big brokerage houses or insurance companies that require you to have some level of production, which means they have to sell a certain amount of proprietary insurance products or annuity products, and that's part of your employment contract, then you're legally, as an employee, being forced to place your employer's interests above your clients. And that, by definition, is not fiduciary. It's not acting in the best interest of your clients. So with that said, just want to throw this in here, especially since it got so much traction on LinkedIn when I had posted it, saying that we recommend working with advisors that are fiduciaries 100% of the time, that don't have conflicts, that don't have production requirements or the need to sell annuities or insurance, or to place a certain amount into cash accounts at a big bank. These are just important things to think about when choosing your advisor. Anything you want to add to that, Gordon?
No, I think you covered that really well.
Okay.
I'm going to talk about ESG investing now. It's been interesting to see how last time Trump was president, ESG stocks did pretty well, or funds. And you would think that his policies would be unfavorable, but or maybe you would think that. But like we saw with the oil prices question before, um, you never know. So, for example, one of the biggest ESG funds around is Vanguard's social index. The ticker symbol is VFTAX, and year to date, it's at 6.95% compared to the S&P 500 that's at 6.66%. So not a big gap, but over time, these things add up. But I think, for me as a proponent of investing of not being afraid to invest in accordance with your values, what it shows is that, the correlation may not be exactly, may not be as tight as you may like if you're comparing to a benchmark like the S&P 500. But some years you'll win and some years you'll lose. And but in the long run, smart investing that are values based can do just as well. The next item here, we have Bulgaria entering the Eurozone. And thanks for putting that map in there. You see Bulgaria is the green on the multicolored map. And it's like the furthest east of any of the Eurozone countries. These are the Eurozone, just to review, this is the common currency. So you have countries like the UK, which are in NATO, but not in the Eurozone. And then I don't know if there are Eurozone countries that are not in NATO, probably. There are, but anyway, so we see Bulgaria. Bulgaria is also in NATO. They've been in NATO since 2004. That's the North Atlantic Treaty Organization, which is, military security alliance. So just the continued growth of the Eurozone and Europe gradually becoming more and more integrated in interesting ways. And then Social Security, coming back to the U.S. Policy, Social Security garnishment begins July 24th. And so what does that mean when we talk about garnishment? So basically, there are a couple of different reasons why the government may want to garnish or take part of your Social Security. What they're saying is that let's see. We had there were issues with people who have gotten benefits incorrectly, and it used to be that the government would only take 10% a year or something like that for the payback, and so they're accelerating how fast they can basically take back money that was given incorrectly. So I feel like it's kind of like a scary headline, but it's not really. Most of us should not be worried about it at all. But you may have seen some headline about that, and if you haven't been the beneficiary of a Social Security error, then you probably don't need to worry about it.
Well, then I guess our last two, which is what most of you have been expecting us to talk about, is the Senate passing Trump's quote unquote big beautiful bill. after marathon voting sessions. They were in the Senate until wee hours of the morning, amendment after amendment after amendment after like this senator wants this thing for their state, so let's wrap it up. I know they're shipping one of the historical shuttles that went to the moon or went to space or something for 87 billion or million or however much. It was a huge amount from the Smithsonian down to Texas. And to me, that definitely is that was appeasing. Some senators need to go back to their constituents and see, I got you a shuttle. That's why I voted for this bill. But beyond that playful jab, there's a lot of changes that will be coming to various tax law. Well, rather, a lot of fewer changes that are coming to tax law. Originally, a lot of the tax cuts from 2017 were going to sunset, so go back to how they were before at the end of this year. Now a lot of that will not be sunsetting. We're still working our way through the bill and how the implications on financial planning for our clients and all of that. So, if you have questions, feel free to hop back on our webinars or schedule a consultation with us. But we're still working through it. We'll let you know if there's any major issues, specifically speaking to our clients, that if that affects you, we'll reach out and let you know how to implement various tax planning strategies to make sure you're in your best position possible. But yeah, we see the new big spending bill, large tax cuts, large various spending, both cuts and raises based on the administration's agendas. So some of our clients might not approve some of the spending. Other clients might be really happy with the direction of the bill. But regardless, there are definitely big changes coming, and we'll make sure that you're all in a good position. We also see, this is kind of tied into it. There's been a spat between Elon Musk and Donald Trump. Of course, Elon Musk, there was a good argument to be made that Trump would not be president without Elon Musk's huge dump truck of cash that bankrolled the campaign. Well, since then, they've had a very public breakup. Trump threatened to pool government contracts for all of his companies, including SpaceX and Tesla and everything. And so Tesla fell 14% on June 5th, which was, $152 billion, the largest ever single day loss in at least Tesla, maybe any company, I'm not sure. So it's been quite public. He threatened after that public spat in early June that if this spending bill and or tax cut bill passed, that he would start a new America party. Of course, he feels betrayed because it's cutting electrical vehicle tax credits, which affects him and his companies, but also like he spearheaded DOGE, the Department of Government Efficiency, so he was cutting government jobs, and then this big beautiful bill very clearly, without ambiguity, increases the deficits, spends significantly more than any kind of savings that the Department of Government Efficiency contributed. So it very much it's understandable why Elon and Trump are at odds, because the policy objectives are very different. And so there's a potential new party coming. It sounds like they're going to be targeting vulnerable House and Senate seats, trying to get 1 or 2 seats in the Senate and half a dozen to a dozen seats in the House. And that would allow them, since the legislative margins are very tight, to be tie breaking, and honestly give them a lot of power to prevent bills like this that are not in the best interest of at least Musk's vision for America. So there's a lot to say about the big beautiful bill and Elon Musk and Trump and the America Party. Do you have anything to add to all that, Gordon?
Whenever somebody tries to start on hand or 1980, I think it was, he ran as a third party candidate, and after failing to defeat Jimmy Carter in the primary. And then, of course, Ross Perot in 92 and 96. At one point in 92, Ross Perot was polling above Clinton and Bush, who were the Democratic and Republican Party nominees, respectively. Ross Perot came the closest to, in living memory. I guess we had third party presidents before. Teddy Roosevelt tried to run later in the Bull Moose Party, but usually when a third party actually gets anywhere, it's because one of the two is dying. The Republicans took over the Whigs. As the Whigs died, the Republicans took over back just before the Civil War, and there was one election where so I would have expected a old line Republican Party to split, of the Republicans. Third parties are good. I feel like the two-party system is, this is just purely my opinion and not really based on, doesn't have much to do with finance, but change is good when things are just static too long when it comes to political parties. So I think it's really interesting. It'll be good to watch what happens.
You make a good point that I didn't actually know that the third parties. I guess it makes sense since the Whigs aren't around and whatever other the Tea Party back in the day, and the origins of the political movements in the U.S. It makes sense. The third party only usually takes root when another party dies. I'm not saying the Republican Party is going to die, but it's definitely not recognizable to what it was prior 2016 with Donald Trump. So it could very much, you could see the Republican Party split in various ways. I did see a lot of political commentary saying that, if, that is a big if, that Elon Musk follows through, he has the money to do it, but whether or not he follows through is different. But if he follows through on starting the party and actually bankrolling candidates to try to take vulnerable seats, it will likely, regardless of him ever getting any seats for the American Party, they could end up with 0 seats in Congress, but simply being candidates that are on the ballot and serious candidates, they're more likely to split Republican votes than Democratic votes. So if this does follow through, and we do see this in 2026 for midterms, it could definitely impact how many Democrats win various seats if it does split votes, and it could hinder Trump's agenda, which, again, this isn't a webinar about politics, but politics does affect finance, especially ones like the Big Beautiful Bill, which has huge tax implications. So of course, we'll keep you up to date with any political news that is relevant to finance, and we'll be watching intently as this drama plays out. At the very least, it's entertaining to watch. All right, so that's our webinar. I think this might be our longest one yet. Of course, there's a lot to talk about, and we aren't always brief, specifically me. I'm not always brief about when I'm covering topics, but I didn't see any Q&As come in that we didn't cover during the presentation. So, and also it's probably a good thing. We're at an hour and nearly 15 minutes. So thank you all for joining. I hope to see you all next month. For those of you that missed, we always post this on our YouTube channel. So feel free to watch the replay, and/or, assuming you're watching the replay now, forward along to any friends or family that would enjoy it. Anything to add, Gordon?
Yeah, just if any of these questions or topics sparked any questions, reach out to us.
Yeah.
And, you know, we love to talk about it and see how it may be relevant to your situation.
Team at Silverstone Financial, feel free to email us. All right. Have a great night, everyone.
Good night.